Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and or financial topics. So I'll just dive right in there. We'll take a look, see what people are sharing, and I will share my opinions as we go. If you want to follow me, @Finance. If you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for potential investment opportunities in the markets and sharing exactly what I'm doing, what I'm buying in the markets here. So Martin Pelletier, he says, I'm sorry, and I'm really not trying to be mean, but how is she still actually managing people's money? And this is Kathy Wood. It says Kathy Wood's ARK Invest has now lost $3.5 million after buying the dip in CrowdStrike at 304.96 and 263.91. So I was looking at that 304. 304 is somewhere on this day, it looks like. And then also she jumped in at 263, which would have been down here as this continues to head lower. The difficult part about this is whenever you see candlesticks that are this big, guys, like this, yeah, you don't want to jump in front of that train. You just let it cool down, let the dust settle before anything. And for the most part, when you look at history, when you get these big selling pressure moves, you almost have to contract it down a little bit. And then you usually get a reversal candlestick. And that's where you want to be buying on that candlestick there for the move on up. You want to get out of on these big, red, nasty looking candlesticks. There could easily be more downside left in this. Or it's in the beginning of a consolidation lower like this one here. So I would be not jumping in front of that train. And I think that's probably what Martin is referring to. It's like if you've been in the markets for a while, you know that you don't want to jump in front of this. And in fact, if you're really, really, really good, you would look at leading indicators and be like, you know what, I should probably raise cash at a certain time and wait for things to kind of re-level themselves valuation wise. A lot of these tech stocks are very high valuations. Insiders are selling like mad. We could very well have a much larger pullback on our hands, and specifically the technology companies. That rotation, as these things sell off, could impact the entire market depending on how fast they sell off. It's a sell everything type of event. So we also could run into that type of environment here. Gold Predictor says gold to USD ratio indicates that the next surge in gold is just beginning, with significant potential to rise in 2024. Another reason we discussed buying the dips a few months ago, downside corrections might be limited due to the ongoing geopolitics crisis in the Middle East. And I don't really focus on any of that. I just look at the charts. This is gold versus the US dollar, and we are breaking to the upside here. It looks absolutely fantastic. And in the market conditions where the yield curve uninverts, the dollar most likely will drop and gold could very well surge here. So I think that's the right way to look at it. And hopefully he did that correctly. He's got gold divided by USD, which gold is already priced in USD, but I guess he's comparing gold priced in USD and the relative strength of the United States dollar. Leading indicators aggregated anticipate near double-digit growth in global earnings in the next 12 months. What's going on there? I like sharing both sides of the story here. So this is leading indicators. The aggregate leading indicators anticipate near double-digit growth in global earnings in the next 12 months. This is Bank of America predictive analytics. So I don't know. We'll have to wait and see on that. Joseph Brown, in real terms, housing prices are currently 1.9% below the 2022 peak. 1.9%, that is adjusted for real terms. That's the adjusted using the CPI less shelter is what they use to adjust it with. We've got the best investing lessons come from this unexpected source. And I want to go through all these investing lessons. So Charlie Munger says there's nothing like a personal painful experience if you want to learn, and we certainly have had our share of it. Superior investing comes from superior judgment, and superior judgment comes from learning from poor judgment. It's not the successful trades that we learn from, but the unsuccessful ones. There's nothing like the pain of getting into a lousy business to find a good one. We tend to remember investment lessons better when we review our investing mistakes. As Manish Pabri puts it, mistakes are the best teachers. One does not learn from success. It is desirable to learn vicariously from other people's failures, but it gets much more firmly seared in when they are your own. In fact, our successful trades often have the opposite effect. We tend to become overconfident. In ancient Rome, after a military victory, triumphant generals led parades through massive crowds. It was a huge honor and could easily lead to an inflated self or sense of self. To combat this urge, generals would have some behind them to periodically whisper, "You are mortal." It was a reminder that the general was still susceptible to the human condition, to overconfidence, to blind spots, to ego. Similarly, it's worth thinking about building a similar mechanism in our investment processes to keep us humble. An investment journal, an investing partner, a periodic review. Making investment mistakes is never fun. It can wear on your confidence and become an obstacle to our development. But there's a better mindset, Charlie Munger says. I think it's part of a life lived right that you learn how to make some lemonade out of your lemons. It's believing we can turn our adversity into an advantage. Or, as the great Roman Emperor Marcus Aurelius put it, the impediment to action advances action. What stands in the way becomes the way. We can turn our investment mistakes into our greatest teachers. It says that is the unexpected source of the best investing lessons. So there are some lessons there. Investing into lessons. If Powell's not confident that inflation is headed to 2% now, there is no reason that he would gain that confidence by September. Powell likely knows there's no way inflation is headed back down to 2%. So he's waiting until September to cut rates to fool investors into believing it is. Yeah, pretty much. Here's Garrett. It says we made it. 4 Fed cuts on deck. Fed funds is 5.5% now, projected to drop to 4.5% by January 2025. In his opinion, this is gold's sweet spot, which I agree with. This is gold's sweet spot because when they start to deliver these rate cuts, this is when gold takes off. Gold front runs the increase in M2 money supply. Gold is the leader, so to speak. It's also the safe haven asset. It goes up during this era of the business cycle, which I would consider this to be we could have a recession in the business cycle or a slowdown, whatever they want to label it as. And we are going through all of the same assets that outperform during that business cycle. I think we are hopefully passing the torch from technology to gold and then eventually to oil and commodities when that comes around. ISM PMI employment 43.4. Anything below 50 is contracting, guys. So only time lower is the internet bubble popping, the GFC, and COVID-19. So those are the only times it's been lower, and that basically works its way into a recession potentially. Someone had asked me, does the PMI employment number indicate a recession yet? And I'm like, well, it's too hard to say. But yes, it's going down, and yes, it could very well result in a slowdown or a recession that we are currently going through. Shares of forecasters predicting a recession, which is basically no one. And I think in the movie, it was like, was it 2012 or something? I can't remember what the movie is. Arnold was on TV, and they were talking about the earthquake, and he's like, "It's no reason to panic." And John Cusack says, You panic when they tell you not to panic. It's the share of forecasters predicting recessions. You panic when no one is predicting a recession. I think that's funny, but very true. Breaking U.S. job openings declined to 8.18 million in June, down from 8.23 million in May, near their lowest level since 2021. Year over year, job percent, marking the 23rd consecutive monthly decrease, the longest streak since the 2008 financial crisis. The ratios of vacancies, a metric the Fed follows closely, fell to 1.2, the lowest since 2021. At the same time, the private sector hiring rate declined to 3.7%, lowest level since April 2020. So the private quit rates, measuring the number of people who voluntarily leave their jobs, fell to 2.3, the lowest since August. So this is what it looks like for the U.S. labor market, is weakening, but it's coming from a real high level too. So we saw these, levels 0.74 drop all the way to 0.15 over that recession. We started at 0.9 and dropped to 0.33 during the recession in 2001. We're dropping here, obviously, but we're coming from a pretty high level. But yeah, this one fell off a cliff in COVID. Here we are, still dropping. Is it going to be a recession? I don't know. We'll have to wait and see. Since everyone is thinking it, interest rates are out here doing everything that bulls thought they wanted them to do. And how's that going? The market is designed to fool most people most of the time. And here's the US 10-year coming down, and here we are dropping again on the 10-year yield. Now, is this the beginning of people running to a flight of safety? Are they running into bonds? Is this entire situation manufactured by the Fed where they're going to create demand for their bonds that they have to offload? I think that's a high likelihood. I think that they're going to manufacture a slowdown, if they can, and get people interested in the bonds and just offload a bunch of bonds onto the market. So that's their bond demand, is to get everybody scared into them. Very well could be the case. Peter Lynch, ultimately, it is not the stock market nor even the companies themselves that determine an investor's fate. It is the investor themselves. Well, that makes sense. Here's Jeff. That's not one, not two, but three critical support levels busted to the downside in recent sessions for the large cap Russell 1000 growth relative to the small cap Russell 2000 value. Support set in 1980, 1991, and 2020 has been taken out. Buckle up, top heavy portfolios. So 1980, that resulted in a slowdown. 91 was a slowdown. We had a slowdown here in 2001, coming all the way back. It looks like we are falling back down. We had three support levels that he has here. He's got the tops of 80, 91, and 2020 kind of going across a couple areas there, and we've broken all three of those to the downside. What this means in this chart here is that Russell 2000 value is going to outperform the 1000 growth, and that's going through the cycle. You cycle up, cycle down, back and forth. And we're cycling potentially back down where value stocks start to outperform those big growth stocks. The chart of death, says Cuppy, and this is ISM Manufacturing July 2024. So we've got prices that are going up, but we've got contraction in manufacturing PMI, new orders, production, employment, and backlog of orders. They're all contracting. So we've got prices going up at the same time that everything else is contracting, and that kind of smells like stagflation. It really does. Kevin Bamborough here. Let's go through this. He says, proper understanding of risk reward, it's key to long-term investing success. So misunderstood, as I self-studied investing in financial markets, one of the biggest common mistakes is associated high volatility with a stock or a sector being risky. You ain't making 5 to 10 times your money without huge upside or downside volatility. Over the last 30 years of investing, most of my biggest winners had many huge drawdowns along the way to be 10x or 20x, or the rare 50 to 100x. Understanding the fundamentals and various key drivers of your investments is essential. Need to know what you're betting on, when you buy a stock or sector, and how much you'll get paid over time for being right, and how much you might lose if you're wrong. Negative real rates, huge debts and deficits, historically low volume volatile sectors like fixed income bonds are essentially all risk and no reward. It's just a question of how much you will lose over time versus inflation. Totally agree on that. Totally agree. That's why I'm not over in bonds or fixed income. There's no way I'd be over there. But he's completely right on all of this right here. 100% right. So let's keep going on what he's saying. Oops. He says, hunting for opportunities where the market has grossly mispriced risk to reward is how you find the best investments. Having the guts to go these bets when you find them is how you make piles of money. Part is analytical, the other part is psychological. Wiring your brain to execute on your well-developed plan is an undervalued skill that is trainable. And that is some of the things that I do talk about on the website, is this exact thing that he's talking about here. How do you find these undervalued things and how do you pull the trigger? That's the three pillars: ratios, market conditions, and technical analysis. Here's more investment wisdom by Charlie. If you make yourself a very reliable person and stay reliable all your life, faithfully doing whatever you engage to do, it will be very hard for you to fail at anything you want. You just keep going and going and going. Mark Berman says green hydrogen is the worst renewable technology by far. It costs $6 per kilogram versus 8 cents per kilogram for natural gas. At least 70% of the energy is lost to making and moving it. Just 1% of the next, or of some 1,600 green hydrogen projects have progressed much beyond the exploratory stage. Next. Yeah, he's not a big fan of hydrogen. And I've read a lot of stuff about hydrogen before, and really hydrogen is a huge energy hog that you'll never get back. So I don't know how it's going to work. Everything that I've read in depth about hydrogen basically says it's a waste of energy. Outside of being able to transport something, in a hydrogen state, it's for the most part a huge energy sink where you'll never reclaim the energy return on energy invested in it. Warren Pye says, reminder, in soft landings, the majority of the move in yields comes in anticipation of the first Fed cut. So we could see 10-year yields and 2-year yields drop dramatically before the Fed's first rate cut, and that is the 2-year or the 10-year front running the Fed. So it says the bond market front runs Fed in soft landings. First cut of the soft landing, and then you can see that rates didn't really go down much more. It was the front run of it. Brady, it says uranium miners did 580% in its baby bull move, but the big move is still ahead, as miners have not yet even begun to outperform the uranium price. Note that this roadmap ratio chart below is now backtesting, and certain uranium company sectors are starting to look bullish. As said, could get one of my everything but USD and yields up moves. This commodity bull is the end of the rainbow, get out of the rat race stuff. It is the opportunity of a lifetime. So that's what he has versus URA versus the Scraw Physical Uranium Trust. I also posted this recently, shoulder, head, shoulder, inverted and ready to work its way on up at some point. But right now, we've just got a lot of selling pressure in the short term because people are afraid. Afraid. So yesterday, Powell insisted that the economy is neither overheating nor slowing. I couldn't disagree more. A sharply steepening yield curve after a deep inversion is, in my view, screaming recession ahead for Tavi. And every time we've got these little arrows here, we've got these red recessions every single time after. So when this starts to come back up, we could very well see, or maybe we're in a recession and then they claim it after the fact. And that's all I've got for today, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website, and we'll catch you guys next time. This is Finding Value.